I'm Taylor Vick, and this is the Real Estate Fund Insider. We're pulling back the curtain on how to grow wealth and passive income through real estate investment funds. All right, Scott, awesome to have you here today. Why don't you kick it off and let us know a little bit about yourself, your background, what you're doing these days.
Yeah. Hey, Taylor. Thanks for having me.
Hey,
Scott Williams, Aline Capital. I am actually also from Greenville, South Carolina. Have known Taylor for a little while. And I am the founder and managing partner of Aline Capital and founded that firm in 2015. And for the first 5 years of the firm, we were just a debt and equity advisory group. So as it relates to commercial real estate. And then in January 2020, we actually launched investment sales as well. So we have a sales team that works in multiple asset classes throughout the Southeast. And from a financing standpoint, our capital markets team works really throughout all of the Southeast as well. I tell people we can, by licensure, we can go to 46 different states, but we really like to kind of operate in the Southeast where we know the deals, know the markets, and feel like we add value beyond just, knowing where the capital markets are. So excited to be here and chat with you guys today in this interesting time in the market.
Yeah, that's awesome. It's funny because you and I, we met in high school. I think we were in the same homeroom. In high school, and we both went to Clemson. We both studied finance, and we both eventually ended up in real estate. And it is neat to have someone who is in the same town that I know well doing something similar. Always good to talk with you and see what's going on your side of the real estate world. I'm really looking forward to what we've got to talk about today. Really looking at what's going on in commercial real estate, especially from the lending perspective. It's been a pretty chaotic year for all types of markets, especially the debt market. And the debt market is what's driving the craziness in a lot of the other markets as well. So looking forward to getting the real pros look at what we've got going on today in the economy, especially as it pertains to real estate and lending. Let's start out with the past so we can give ourselves some reference before we talk about today and maybe what's going to be happening in the future. So let's take a look at the past 12 months. Like, where are we, or more, how did we get here than necessarily where are we now?
Absolutely. So, not long ago, 12, maybe even 14 to 16 months ago, the treasury rates in the bond market, which is what we base a lot of our permanent financing rates off of, were at historic lows, mostly driven by the pandemic. And also the floating rate indexes that we use, mostly impacted by the federal funds rate, which had gone to zero at the onset of the pandemic. Both were at historic lows, and borrowing interest rates on both short-term and permanent long-term financing were at we're all-time lows. So we were seeing, I didn't close any loans below 3%, but that was more of just like a perfect timing type thing. A lot of people locked in, long-term, maybe even 10-year fixed rate money below 3% on some loans. And we were seeing some floating rate loans, kind of in that 2% range. So really wild to have just been, 12, a little over 12 months ago. And I'll tell you what, kind of the big conference I go to for our capital markets industry is the Mortgage Bankers Association Commercial Real Estate Finance Conference. And that's February every year. And I'll tell you, all the way into February, I had meetings. We went to the economist presentation, and the economist predicted 3 rate hikes at 25 basis points apiece for the entire year. I had another meeting with the chief credit officer for a large New York-based bank who thought that in March they would do a 1% increase. And then went to a meeting later that day with one of the desk traders for one of our larger lenders. And he was saying, he was very analytical about it. He said, well, there's about a 73% chance of a 50 basis point hike in March. And so I'm sitting there literally 3 weeks from the first rate hike with just absolutely no consensus in what was going to happen this year.
And all completely wrong.
All just couldn't have been more wrong. And they say, future predictions are the hardest ones to make,
of course,
which is why I try to abstain from it. But it was just interesting. And I think that, pointing just a little bit further back, the Federal Reserve and the market both had an extremely low probability of rate hikes for this year. I won't say which bank, but one of the top 5 banks in the country had a 95% chance of 0 rate hikes for 2022. And I would say that has just framed up the theme of this entire year, which has been volatility. And I would say volatility due to lack of consensus, and then also volatility driven by a lot of geopolitical factors. February of last year is also when the Russian-Ukrainian conflict started, which a lot of experts tell me that there's about 30 basis points of volatility baked into the bond market purely based on that conflict alone. So, 12 months ago, historic lows, 2 and 3% interest rates on money. Fast forward to where we are today, much different time. And I think kind of the theme of all of 2022 has been volatility, and volatility driven by lack of consensus.
Yeah, that's a good way to put it. And, unfortunately, the only perfect hedge is in a Japanese garden. There's no real way to do it right, And,
I'm going to write that one
down. I stole it somewhere else, so let's continue stealing it. The thing is, we've been pretty good with interest rates for our strategies, for the past, 10 years. With rates, you talked about 3% rates, below 3%. We had about 3 loans, I think, below 3%. Some of those were swapped. We, made massive fees on some of those when we decided to get out of those. So a swap is a synthetic way to basically give you a fixed payment. And if rates go up, you can get paid to pay the loan off.
Right.
If they go down, you get the other way around it. Scott, I know all this, but we made the correct thing there where we got paid out on a lot of those. And I think historically we swapped at the right times, we fixed at the right times. But this time we did went float at the wrong time. Mm-hmm. And like you said, 3 25 basis point hikes for 2022, things like that. With SOFR, which is the index that's affected by or controlled by the Fed, one of 2 interest rates the Fed actually controls, was at like 6 basis points, and we were floating at 190 plus. So we're like, all right, we got 1.96% interest rate today, and we're being quoted 5%. So we're going to have this many rate hikes before it could ever get there. And that's going to take a number of years. And the savings, from here to here, while it's ramping up, we're going to save so much money that even if it goes a little higher than what the fixed are now, we're going to be good. Little did we know we were going to have the most aggressive rate hikes in history, period.
Right.
So, I think, we're dealing with some of those issues, and, we're navigating through them. We've got strategies to take care of, but, just to hit more on your point, Scott, you're right. It's been crazy. Bonds have been killed. Stock market's been killed, but we've been happy to be able to give regular distributions to our investors, part of what we look for, stability, but it's tough. So Scott, with that background, what's going on, right now? What are you seeing as far as what lenders are doing, what investors are, how investors are utilizing financing, where different asset classes may be more desirable for lenders? Give us an idea of what you're seeing kind of today, real time.
Sure, absolutely. And so to kind of take your first question in terms of what lenders are doing, especially, a lot of the banks, a lot of the banks are extremely well capitalized right now. And a lot of the banks aren't deciding what rate are we lending money at. They're deciding, are we risk on or are we risk off right now? Are we lending at all, or are we, not lending? And, we really saw that shape up over kind of the end of the summer. I would say July, August is when we saw a lot of lenders start to kind of pull out of the market, given the volatility. And it's been frustrating because, you have these phone conversations and you make the phone call and it's not, hey, what rate are you guys putting money out right now? It's, hey, we're not putting money out at all. And so beyond just the interest rates increasing, the shrinking pool of active lenders out there has been a big challenge for investors as well. So I would say from a what are the lenders doing standpoint, the bank's cost of capital hasn't really moved much in terms of deposits, and they could be putting out money at tremendous yield, but for a lot of them, they've just gone into this complete risk off attitude right now, and have pulled out of the market. That said, I was just down at the Urban Land Institute's for the Carolinas, the Capital Markets Conference. We hold that down in Kiowa every year. And, I would say outlook was really overall positive, even from a lot of the lenders that a lot of them think this is going to be, shorter term. But, it was unprecedented, to your point, at the rate at which the hikes came. And there was a chart. So the head of capital markets for First National Bank was the economist that spoke at the conference. He was actually phenomenal. I've got some notes from him here, but he was phenomenal. He broke it down into layman's term, and he had an overall bullish outlook, but he had one chart in particular that showed the pace of the rate hike. So the rate hiking cycle here versus the last 5 rate hiking cycles. And it was just an absolute hockey stick, where everything else was kind of a stair step and some shallow, some even kind of steep. I mean, this was 2 to 3x steeper and just an absolute straight line. And so, the pace at which it came caught everyone off guard, but really that happened in not only the permanent rate indexes, but what was most impacted, to your point, was the floating rate indexes. I think when we started the year, SOFR, which is the index we use for floating rate that replaced LIBOR. At some point, I knew what both those stood for. You probably know, you having your CFA probably know exactly what
I think it's secured overnight financing rate.
I think that's it. That's it.
I could have one of those words. Andy Spade, he's the real CFA from our
company.
He's more CFAE than me these days for sure. So
I just use Google, but that's great that you have a guy that knows too. No, but I mean, that was it. To your point, 5 or 6 basis points at the start of the year, and it's at a little over 4% today. So it's 4.12, I think, as of this morning, versus, so that's a legitimate just over 4% increase within 12 months on the investor.
Well, and just in measurements of interest rates, it's a 4-point increase. But if you actually look at the percentage increase from 4 basis points to 400, right? Yeah. That's what 1,000, 10,000%. I don't know. Yeah. It's orders of magnitude.
Substantial. And you made one other good point, that you guys have been good to consistently put out returns. One thing I'd say is that one thing that's great about real estate is, I say a lot of things. One of my biggest sayings is, life is a double-edged sword, right? And real estate being an illiquid asset, being a negative in some regards from an investment standpoint, real estate being illiquid, being, non-reactionary in a lot of ways, has also helped during this time. And to the extent, even those that were in floating rate deals, if you have long-term outlook, it's been a good place for a lot of people to be. And one thing that I give, I kind of talk to everybody about, they're like, hey, my investors are worried about this. My investors are worried about that. These interest rate hikes haven't happened to one group. They haven't happened to one. They've happened to the entire world effectively. Right. And I mean, absolutely the US, right. But the entire world, in terms of those that are interested in investing in US based real estate, have experienced the same pace of rate hikes here. And so for those of you that you're kind of beating yourself up, you're in floating rate debt at some points throughout the year, floating rate debt's still not an absolute terrible place to be, depending on what your outlook is. Right. And here's why. Fixed rate debt a lot of times carries some sort of prepayment penalty or penalty to get out of early. And depending on what your outlook is for a particular asset, we're actually in some cases still advising clients to go into floating rate debt, solely because their business plan, or when they have to return capital, or, their business plan for a particular asset, depending on when the kick point for, that money needing to be returned or needing to exit or needing to refinance, floating rate debt and taking lower cash flow in the very short term might still be the way to go.
We took that kind of strategy with a couple of assets, Scott, and it's like, you're talking about what happened this past year, and it's like, all the nightmares are coming back. But we were under contract on a number of properties in that time period where you referenced banks started pulling back. This was in July and August.
Right.
And the banks, cut our advance rate from like 75% to like 45%. So we had a massive capital need out of nowhere. They cut our amortization from 25 years to 20 years. And what we elected to do was to go floating rate debt for two reasons. Because we were so equity heavy, we knew we were still going to have good cash flow, even if the cash on cash return wasn't that great. And the second reason was to restructure or to refinance that loan with no kind of prepayment penalty, since it was the LTV was so low and the amortization was so short. So I agree with you. That's one great reason to use floating rate debt. And let me know what you think about this too. I think it's appropriate almost always to have some kind of both floating and fixed rate exposure.
Right.
But today's, between the yield curve, how quickly rates were increased and how quickly, I'm scared to say historical now, but how quickly rates have historically decreased when the economy was looking negative. If you're floating, you can really take advantage of it going back, maybe in low twos on your all-in cost there.
Absolutely.
Yeah.
No, that's so I posted an article on LinkedIn. It might have been 3 weeks ago now, but it looked at the last five rate hiking cycles, sans this one, last five rate hiking cycles, how long the Fed stayed once they got to where they wanted to raise to their terminal rate, and then how fast they came back down. And what's interesting is historical context is that rate cuts typically come twice as fast as the hikes came. And that would be unprecedented. And again, future predictions being the hardest one to make, it would be unprecedented, being that I kind of showed the shape of the graph being like this, to come down twice as fast would be almost straight down.
Just like 2 months, cut it to zero.
I don't think that's necessarily completely out of the question, and maybe not come all the way back down to zero, but for them to come back down very steeply. There's a lot of talk out there based on the indicators that the Fed look at. Is there quite a bit of lag in the data, that sort of thing? All bets are that rates start to come down, maybe second half, maybe even as late as fourth quarter. There's a kind of a lot of people talking about that. Light at the end of the tunnel could come earlier than we think, and maybe even late first quarter, early second quarter, when, we start seeing some cuts.
So this TV behind me, I usually keep on the financial news when I'm in my office. And I remember when those numbers came out, and, S&P and Dow went crazy and the bonds rallied too. So, when bonds go up in value, essentially the interest rate goes down. That's not exactly what happens, but your yield does. And so I remember seeing the treasuries rally, and I was like, man, this is nuts. And it was right. It was pretty close after a Fed meeting, and then interest rates were lower than before the Fed meeting, even though they had hiked 75 basis points. And that's one thing I like to remind our investors, is that the Federal Reserve does not control interest rates. The Federal Reserve has the ability to set two interest rates, the Fed funds rate and SOFR. And those are rates at which banks lend to each other through the Federal Reserve System, so the Fed is able to affect some interbank lending is basically what they're able to do. They also can do things like buying treasuries and selling treasuries, quantitative easing or tightening. There's a few other things they can do, but the main one is adjusting these interest rates. And so despite those rates have just been adjusted up, we were able to borrow money at a lower rate because the capital markets had improved and became more positive. And I don't think I looked at a yield curve before and after, but I'm pretty sure it increased the inversion in the yield curve too.
It did. Yep.
Yeah. So, the yield curve is the plotting of what generally treasury bond yields are over different maturities. And, as you would expect, yeah, usually for a number of different factors, the longer the loan, the higher the interest rate, the longer the maturity, the higher the interest rate. So inverted yield curve is when essentially the US government can borrow short-term via borrowing bonds. When they borrow short-term is higher than they can borrow long-term, which again, there's so much that goes into it, but it's generally an indicator of two things. One, a recession. It's predicted 7 out of the 7 last recessions and didn't miss one. And didn't falsely predict one either, yield curve inversion. And the other thing is that future rates are probably going to be lower than current rates.
Right.
And just so the Fed has still been pushing up those short-term rates. And so we've seen those go up, but the positivity in the capital markets has pushed down the longer term rates even more. So we're in a very, very interesting time, for borrowing and interest rates all over.
No, absolutely. And that's why, I overall kind of have a positive outlook for this. And I think most real estate professionals and investors do. To my point, saying I was just down at this conference, there might have been 350 people or so in the room. And, sentiment was tough, but it was pretty uniform that everyone kind of showed up. Hey, do you know how to get a deal done right now? No, I don't. I can't get a deal done. And but
equity,
yeah. While everything was everyone was kind of in the same boat as deals are really tight, deals are really tough. The other, the flip side of that was everyone said, I think it's going to be pretty short term. I think this next 6 months is going to be pretty turbulent. It's been pretty turbulent in the past, maybe. Well, it's been interesting all year, but I would say, it's been very difficult and interesting the past 60, 90 days. And I think, the next 6 months is kind of the outlook for that as well. But people are starting to figure out how to navigate it. I think to your point, the market, and my point being the market's sufficiently priced. I think there's a lot of data out there showing that, we're headed back to a softer place than we are right now. Now, my kind of forecast is that we'll go back to, kind of normal borrowing rates for longer term debt of maybe 5 to 5.5%. Which is reflective of like a high 2, low 3% 10-year treasury rate. I think ultimately that a lot of people kind of concurred that maybe that's even where we're headed for the, kind of that intermediate shorter term after this next 6 months of just being out of whack, where things might kind of start to normalize, at least for the, the moderate medium term, if you will. No real long-term predictions, and all of this one black swan event can take all of this completely sideways. But I think all things being equal, we're kind of headed back to that range.
Yeah, I think you're right. And, for guys like us, sometimes it's hard to remember that, 5.5% is historically pretty normal,
right?
Because rates have been so low throughout our careers. And I think you're right. I just kind of get this feeling that the Fed's like, we've had all these crazy low interest rates, for the past 15 years. Every time we tried to get them up, notch them up higher, black swan event, cut them back to zero. And that's, it's not really good for an economy long term to have like this super, super cheap debt all the time. And I think they really want to try to normalize it again. But you never know. They seem to act. With COVID, I believe that they acted more aggressively than they've ever acted before during a recession. I think part of that is from what they learned from the last one of cutting rates and twisting the yield curve and quantitative easing isn't going to do it. You need cash injection into the system, and I think Congress and was ready with that kind of stuff. So they I think they want to get to a place where they're like, the economy is not being solely fueled by cheap interest rates and government grants or government handouts. We want to have something that's going to be long term more stable. Right. So I kind of get a similar feeling.
And one thing that's interesting that you brought up, I think twice now, is the kind of the past 10 years. We have to look beyond that now, because 2008 was a very unique kind of catastrophic event in the markets, right? And so the recovery beyond that, it's when you look back at 10-year average this and 10-year average that, man, you really almost have to go beyond that to see what was normal in a normal operating cycle before the first time that rates got kind of cut to zero in modern day. What the average or what normal was beyond that. And so, yourself and me, we haven't been in the workforce past that. Now, luckily for us, is we were kind of classically trained in finance and, knew beyond all of this, knew what the inputs and outputs, but arguably a third of the workforce out there, and even a third in our profession, has never even been in a market cycle like this or a market like this. So we've been doing a lot of looking at beyond the past 10 years and 10-year averages at things to kind of see what is normal ultimately.
Yeah. And, maybe to get a little bit too historic or a little bit too academic, the country of England essentially invented the modern debt markets by issuing bonds.
Right.
And those were at 5%. They may be bought or sold for more than par value, but those were at 5%. And I don't have them in here now, but I used to have some historic bonds on the wall. They're all 5%. These were from 1930s, 1860s, and turn of the last century. They're all 5%. That has historically just kind of been the standard. Sometimes we forget that getting a mortgage at 3.25% wasn't high when we started doing it at 275. And it wasn't normal either. It was still really low. And 5%, 6% is kind of what normal is. So Scott, let me talk to you a little bit about some of the strategies that we're employing right now and kind of get your feedback, see what you think.
Sure.
So what we're looking to do is take some of the debt that we currently have, especially floating rate debt. So I kind of mentioned some that we got retraded by the bank kind of last minute, had to come up with extra equity, elected to do floating to be flexible. So with loans like that, what we're looking to do is, first off, we're trying to get the amortization stretched back out. And then we are fixing those rates. We're looking at fixing between like 580 and 615 for I think 5-year money with 25-year and actually 30-year AM as well. So that's going to give us a much more cash flow. The thing that I am trying to really focus on is maximizing our prepaid flexibility, because I really believe rates are going to drop sometime in the near future, but we don't have the ability to take on that full interest rate risk of just going floating. We want to make sure we have some fixed, because our mission is to deliver that monthly steady income to investors. So we got to protect that first. But I don't want to lose our ability to take advantage of rates getting lower. So we are going on balance sheet with some banks instead of doing floating or swapped or things like that. And for new acquisitions, putting in more money than usual, it is lowering our return on equity, but it's given us that cushion for debt service coverage. And then same strategy there. Yes, of course, try to get the lowest interest rate possible, but worry less about maybe the term. So some we've done on like 3-year terms, and worry more about prepay, really, so that we can be able to refinance at an opportune time. What do you think about that and some other strategies that you're advising your clients on?
Yeah, no, I think that's it. I mean, to the extent you can negotiate those down, and that's our conversation with everybody on the front end. So, one interesting area is a lot of credit unions by charter cannot charge prepayment penalties. We've done a lot of credit union business the past, really 2 years. But especially this year, we've been looking to them strongly because a lot of them have very soft or no prepayment penalties. The banks are going to be your second place that have the most flexibility when it comes to prepayment penalties, especially your regional or community banks. Your larger banks also, but sometimes those balance sheet decisions are made at a level that we don't have access to. Right. One of my clients called me and they want us to waive the prepayment penalty, and some chief credit officer sitting in some gateway city, has put out a mandate that we're not doing that anymore. So not that the big banks are not the place to be right now, but it's just, a lot of times you do have a lot more leeway with some of the more regional and community banks. So no, I think that's absolutely it. I wouldn't be, my bet's kind of in that, I think 3-year money is a good place to be. 5-year, Really not a whole lot of reasons to be locking in 10-year money unless you have very flexible prepayment. You can kind of get the best of both worlds, right? So I've got maturity protection without also out the prepayment risk. The ones you want to stay away from right now are certainly, any loans with defeasance or yield maintenance. Which can be debilitating prepayment penalties early on in those loans. They don't operate like swaps. Swaps, you can, to your point earlier, you can be in the money to where if you've gone into a swap and interest rates have shot up, the lender may want you to pay that loan off, and so they may actually let you out for free or even pay you to get out of that loan. Yield maintenance and defeasance, there's not an ability to do that. Rates would have to go up even much more substantially than now for you to be in the money at all. I won't go into pure definitions, but yield maintenance, really what that is when you pay that loan off. You have to pay off the full balance, the outstanding balance, and then you have to pay off all future interest payments at the net present value. And the discount rate is the nearest term treasury. So if there's 7 years left, the discount rate would be the 7-year treasury rate. But as you can imagine, that net present value figure is still going to be substantial. So yes, as rates go up, yield maintenance and defeasance, which is slightly different, they come down, the penalties come down, but they don't go to zero. So you could be in a 7-figure loan with 7 years left and have a 7-figure prepayment penalty as well. So you got to be aware of those. No, I think that's a great strategy. And then what else we're looking at is, with rates not coming back down to where they were, one thing we've been setting ourselves up for as a firm the past 2 years, because I thought this was going to happen sooner, but they're going to be more tranches to the capital stack on a normal basis, going forward. Sure. Whereas a lot of time it was just senior debt, and then maybe you had 2 tranches of equity, maybe you had LP investors, and then like a promote interest for the asset manager or the sponsor. But you really just kind of had senior debt, and then you had common equity on top of it, right? I think going forward, there's going to be more tranches of that. Maybe you're going to have, senior debt from banks, and then you're going to have mezzanine or preferred equity layered in there. So, historically we would transact where deals could get, 75, maybe even 80% on a wild day, 75 to 80% from a senior lender. Now that's kind of in the 60 to 65% range in most cases, could be even lower. Mezzanine and preferred equity providers are kind of filling that gap back up to 80, 85% leverage. And so I think you'll see those. And the beauty of mezzanine and preferred equity is they don't have upward participation, right? So they have a kind of a capped coupon that you can model. And while it is a higher cost of capital than historically senior leverage, on a blended basis, if you're putting in, only 15, 20% of this slightly higher cost of capital on a blended basis, that still could be even cheaper than trying to layer all just participating or common equity in there. So I think you're going to see that. You might even see even more layers. So you might even see senior debt, mezzanine and preferred equity, and then joint venture equity with waterfalls to the sponsor up beyond that. And so I think that ultimately you're right to be looking at kind of that 3-year, 5-year outlook, managing prepayment penalties, trying to get something fixed. But then I think on the go forward, I think the capital stack's going to look a little different. And I like that too. I think it's going to be, there's a lot of players out there that are extremely well capitalized to fill that void. And I think there's going to be a market-based solution. And then I think, it's going to get a little more interesting, and the market's going to kind of put it back in the professionals' hands. I was talking to another real estate operator earlier, and it's kind of been frustrating that, any certified rich guy has also been really successful in real estate without having to have any knowledge. There's been a lot of blind squirrels out there finding nuts the past couple of years. And, in terms of us, where we, maybe are more conservative in some situations, because we know that factors like what's going on right now can present themselves. We've been a little more conservative. I think you're going to see a lot of the kind of hobbyists and non-real estate professionals start to leave the market a little bit and put it back in the hands of professionals like yourselves, and start investing with, professional groups like Blue Ridge and that sort of thing. So I think overall this difficulty and these headwinds are going to bode well for kind of the professionals.
Yeah, no, I think that's great. I will get a little definitional. You kind of mentioned some on prepays, But I just want everyone to kind of have an idea of what we're dealing with and what we're looking at in all these different situations. So, most people think you get a loan and you can pay it off, and it's either, maybe they know it's either fixed or floating, because that's what's available in the consumer market, which
Right.
is generally a fictitious lending terms that are created by the government, through government sponsored entities like Fannie Mae, Freddie Mac, and things like that. But in the real world, where you don't have the government kind of affecting consumer protection type stuff, you don't have that. And so we have to look at a lot of different options when it comes to fixing debt or floating debt. And like I said earlier, the only perfect hedge is in a Japanese garden.
I love that.
Yeah, I mean, no matter what you do when you borrow money, you're speculating. You're either speculating that rates are going to stay the same or go up, so you get fixed rates, or you're speculating that rates are going to go down, so you get a variable rate. Which, there's other reasons for those things, which we've discussed as well. But on a very simplistic form, there's no way to not take risk. It's just how it's kind of how you want to take it. Most people say, well, getting fixed is less risky. It is in the sense that it's less likely to change, but that doesn't mean you're not taking on risk of rates the possibility to go down and you make more money. When we look, fixed variable, you've got these different lenders and these different products and different prepays. So I'll rank them from worst to best people to deal with, and best to worst terms in some ways. But and Scott, please correct me when I say the wrong thing here. But you've got the CMBS market, or the CMBS lenders, which those are the most unflexible terms, because it is a securitized product, and you can't renegotiate things. It is what it is, and that's where defeasance comes in. And me and Andy Spate in our group, we actually used to do bond defeasance at BB&T. But what a bond defeasance is literally buying treasuries, putting them in an escrow so that the treasuries mature when the payments occur and are able to fund the payment. So you are not paying that loan off. That loan is still out there.
Yeah.
It is legally defeased, meaning it's not your obligation anymore, but the ultimate creditor, which is the holder of the CMBS investment, is still going to get the payment as if you were paying. Now it's just being done through a portfolio of treasury maturities, which are allegedly risk-free, so that you can legally get off the hook for that debt. Then kind of next step down, in my opinion, is life insurance companies. So you can renegotiate, you get a little bit more flexibility than the banks, but they're not as nice, but they're not as strict as CMBS. With CMBS, you can get longer terms, longer amortizations, and non-recourse. Same thing with life insurance companies. Are kind of in the middle between those two, but they essentially lend to do asset liability management with their premiums and their benefit payouts. So basically, if they don't make money on the premiums from investing them, they won't have enough to make payouts or enough to have profit. So they're very focused on, hey, we locked this loan in because we have this prediction of benefits, and we need that structured payout. Like we did this with billions and billions of dollars. You can't change it. So what they have is yield maintenance. Yield maintenance, or make whole is another term you see sometimes, which mathematically you're probably going to land at about the same answer, but technically it's different. So they're essentially going to do the same math as what does it take to build a bond portfolio of treasuries to make sure we get these same payments. But instead of buying it, because they don't have to pay a third-party investor, instead of buying that portfolio, they take the money themselves, and then they're going to lend it out again or do something else with it.
They achieve the same yield.
Yep. So that's exactly. That's where the yield maintenance part comes in. It allows them to maintain that yield. Exactly. And then you have banks, and with those, you've heard us say swap a lot in me and Scott's conversation. A swap it's basically an agreement with a third party, and it's usually is the bank, and then they go on the back end and do a bunch of derivative stuff. But you've got a your loan is actually floating rate. You read your loan documents and you're a floating rate loan.
Mhm.
However, you put a swap on top of it, and there's a series of back and forth payments. But essentially, what it means is you're going to pay the same amount every month. So you're either paying the interest that you owe or the payment that you owe plus a little bit more to the third party, so that you have fixed, or the other way around, the third party is going to pay part of your debt service essentially. So your combined payment between those two things the same. And that's where that break fee comes in. So if you're the third party and you're like, hey, I'm paying this dude every month, like I'm not getting anything back, I'm literally just paying his loan for him, I would give this guy $1 million or whatever it is, $50,000-$100,000, so I can just get out of this deal altogether. That's kind of what that swap termination is. And it's
right.
similar, there is still, your net present value kind of calculations going on, but essentially it's more based on the actual interest rate that your loan's associated with versus treasury, which are always going to be lower and put you at a disadvantage. So that all sounds really good, except on the flip side, if you want to get out of it, then you're paying a penalty. Probably not as bad as defeasance, but same kind of concept of the third party is now like, look, I'm getting paid by this dude every month. I'm not just going to let him get out of this. He's got to pay me if he wants to get out of this. So same kind of thing. And then you've got the banks on balance sheet fixed, which those are a little bit more discretionary. So what we see a lot are like step downs, 5% penalty in the first year, 3% the next year, just on the principal amount. And those are more negotiable, especially if you're like, we have a lot of visions where, okay, this is a prepayment penalty, but if we sell the property, we don't have to pay it. You don't get that with all the other things I just talked about. Or if we refinance it with you, we don't have to pay it. If we refinance it with another bank, we have to pay it. But if we come up with the cash and pay it off ourselves, we don't have to pay it. So you're getting a lot more flexibility here with the banks, but you're going to get shorter terms. You're probably going to have to personally guarantee it.
Right.
It depends on the structure, but there's other terms that may not be as good. So anyway, that's like my quick thought on how debt works in commercial real estate. Scott, tell me what I'm
No, that nails it. And
Yeah.
the only thing I'll add, which is perspective that not a lot of people have, is lenders are also investors, right? Everyone's like, lenders aren't investors, they're lenders. No, they're also investing that money. They are lending you that money to earn a yield.
Yep.
And, depending on how many times that investment has been sold upstream, which is the most it's sold upstream is typically in the CMBS world, the more it's out of that control, the more the yield has to be guaranteed. And what you're getting for that, to your point, is going back to my comment, life's a double-edged sword. What you're getting for that typically is longer term, better amortization, usually non-recourse in those situations. So you're getting perks for those things, but and the amount of times it's sold upstream and the amount of times it's tranched and, parsed off and sold different ways upstream is how everyone else hedges the risk of giving you those terms. So lenders are also investors, and they're looking for yield too. And, to the extent, a bank, if interest rates are going down and a bank, you're a good borrower, bank's like, man, we really, really would like this loan still on the books because we're earning great yield on it. But if you sit there and say, well, hey, we're going to pay that, we're just going to walk our relationship somewhere else, maybe there's a lot more flexibility there. So, two takeaways: lenders are investors. They're solving for a yield too. They're giving you the terms on the front end, expecting a yield to pan out on the back end without it being perfect, but some modest protection. And then, the more it's been sold upstream and the more it's been hedged, the more it's out of their control to give you any flexibility on those.
Yeah, to change it. Yeah, that's a good point. I always say the bank puts in more money than we do. So, they're taking on risk for sure.
Sure.
They're secured for equity, but they are putting in more money. So we've done kind of our definitions of all of the debt. Scott brought up something really important in our world, which is, capital stack or debt stack. It's basically the way in which you come up with the money for a deal. So he mentioned when interest rates were really low, it really just made sense to borrow as much first mortgage money as you could and put in whatever equity was required for the rest. I always say debt is cheaper than equity. So if you're looking just at your cost of financing period, the more you borrow, the more you drive it down. Obviously, there's other things that must be considered there, but as far as just purely how much does this cost, it's going to be less expensive. and as I remind our investors a lot, your money has a yield associated with it too. Just because it's cash you have in your bank account doesn't mean you should use that instead of borrowing money, because you deserve a yield on your money, and it should be higher than what debt is. So any dollars put in, there is an associated cost. Scott, you started talking about some more complicated structures where you mentioned, hey, we've got that first mortgage and then we've got that mezz debt. So mezz debt is a lien on the equity invested, right? Not on the property itself. Is that right, Scott?
Yeah. So mezz debt, correct. So mezz debt is not a lien against the real estate. It is the collateral for mezzanine debt by definition is the equity interest in the ownership of that property. And so a mezzanine debt foreclosure is actually a UCC foreclosure. It's not a property foreclosure. And so that mezzanine space typically goes up to about 80 to 85% of the total capital stack. And preferred equity fills that same spot. And it generally also prices the same. So why would you take one over the other? Well, preferred equity generally does not have collateral against the shares of a property. And it's generally more favorable to senior lenders, especially banks and less sophisticated instruments. They would rather see maybe a preferred equity tranche serve that space. And the reason is, whereas a mezzanine lender, you miss payments, they can come in and foreclose. Now they've taken your ownership interest. They maybe even taken control of it. The lender's saying,
now
hey,
they're the boss.
Yeah. The lender's saying, hey, now they're our borrower. We didn't underwrite them. We don't know who these guys are. And they didn't sign our personal guarantees. So they could, where we don't like this as much. Whereas preferred equity, typically you would see it is senior to any payments being made above them, common equity. But usually their rights are that they can replace like a property manager. Maybe they can replace you as the manager of the deal while you also maintaining a majority stake. And then 3, they can drag the deal to market. They can force the deal to be sold. They can actually go and have the deal sold. And the lender, while you would kind of puts them in a similar position, it doesn't. A property being sold is a lot different than someone coming in and taking over that the lender doesn't know. So those are kind of the two different things, but they typically serve the same area in the capital stack. And one other thing to your point is, hey, borrow as much senior debt as you can. Well, what's interesting is, back when you could borrow 70, 75% senior debt, you're like, oh, well, I'll just put mezz in here at 80, 85%. Well, a lot of times those guys want a little bit bigger piece of the pie, or they think it de-risks the deal for there to be less senior debt in the deal. So you may have to squeeze your senior lender down to 65% leverage, even if they could theoretically, by the lender standards, do more in order to be able to put that in. And so it really kind of becomes this finite engineering game of like, at what point does squeezing the senior leverage down and putting in another tranche of capped upside in, where does that make sense for your deal? It all just depends on what your upside, flow is to the LP and common equity, what the splits are and that sort of thing. So that's the way we like to view the world. I say we try to solve the capital stack from the top down a lot of times. It's not straightforward. As everything we've said, it's not really that straightforward. It's not straightforward in terms of where it starts to make sense. It's really kind of a financial engineering game, if you will.
Yeah, it is. And I think, a misconception a lot of people have is, okay, if you borrow money, it's because you don't have enough money and you actually don't make as much money because you're paying the bank. And that is very naive and not even close to what reality is.
Right.
That's, the real thing going on, and what Scott is talking about is, for what we're calling common equity. So that'd be like your down payment money, what the investor's putting in, essentially that number can be 100%, the sponsors, whatever, they can get that money, they can do it 100%. However, what they do is consult with someone like Scott, and they're like, let's dial all these different capital sources in and achieve the lowest, I don't know if you call it this, Scott, but weighted average cost of capital.
That's exactly what it is. Yep.
Kind of an academic term, right? But basically, here's 100% of the money, 20% is 7%, blah, 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 30% is 10%, multiply those out the percentage of the stack that it is and the cost of that debt. And what does that average out to? That's how much it costs you, to fund this deal. And so, a lot of times as investors, we're looking to achieve that lowest weighted average cost of capital, or WACC, as people call it sometimes. But, like Scott said, none of this is as simple as it seems. And each one of the, I think I did like a 10-minute monologue about different debt in commercial real estate, and that was super high level. And, we could probably talk about that for 2 or 3 hours. Well, you can do the same thing for mezz debt, or preferred equity, or common equity, or limited partnerships, or JVs. These are all like highly complicated structures, and they also all carry different risks. So, and they also have different tax advantages too. So, you got to weigh in the tax advantages, you got to weigh in the risk aspect. You have to weigh in, what is this project, and does this, type of capital align with it, as well as trying to find out your cost of capital and your debt stack. So yeah, I think, financial engineering is a good way to put it. This is mathematical, but there's also, some qualitative aspects too that have to be fine-tuned to what you're trying to achieve with your purchase.
Absolutely. Yep. Absolutely. And the whole goal being to maintain positive leverage throughout, based on where your business plan is, and doing your sensitivity analysis to where, if the base case doesn't pan out, where does this become a bad idea? Right. Yep. And then just willingness to take risk on those fronts. So all very interesting. Yeah, it's none of it's as straightforward. So Taylor's doing a lot more thinking than maybe anybody out there that's investing with him thinks. So if anything,
hard to believe, but
know that he's really thinking through all these things.
Yep. Well, people like Scott, that's why I know a lot of this stuff. Scott has immense knowledge. So a lot of this is just me summarizing things he's told me in the past. So,
I have immense knowledge of one very small segment of the world. Yeah.
Well, that's right, Scott. And that, that's one thing we try to do at Blue Ridge, is not just learn this knowledge for ourselves or for the funds that we run and manage, but also when we're consulting with our individual clients is, hey, look, here's my crash course in this. Let me hand you over to Scott. He's the best I know for this, and he can implement this strategy for you. So we have a knowledge of a lot of different things, so that we know where to point people, and then we know the people to point them to achieve different strategies if it's outside of our direct control as fund manager, if it's something outside of that. So Scott, to wrap it up, how can people get a hold of you if they want to reach out and talk, and what is your typical client profile as well?
We've got a lot of good information on our website in terms of current rates and things like that, especially too. So where all the indexes are, we've got it right there on the homepage. So our website's alinecapital.com, and Aline is ALINE. So alinecapital.com. And then best way, I usually give out my cell phone number, but it's become an inefficient way of getting a hold of me. So I can queue you and get back to you at most efficiently. My email is S as in Scott, and then Williams last name. So SWilliams@alinecapital.com. And I would say, typical client profile is we try to deliver a high level of knowledge and sophistication to the middle market investors. So our deals range anywhere from really like $2 to $40 million. We've been blessed to do some larger deals. We typically aren't very effective under $2 million, but if you're a commercial real estate investor or developer looking to borrow over $2 million, or you're also an investor looking to buy these deals, we try to offer a holistic solution to where, we've got investment sale advisors that can come in and help find you a deal. And then our capital markets team will look at how we can put together the most efficient way to capitalize it for you.
Awesome. And you can insure it too, right?
We launched an insurance division focused on commercial real estate owners and investors, because what we found is there are a lot of headwinds in insurance right now. Premiums going up 20, 30, 40%. And, we understand the flow of a real estate deal. We understand what a due diligence period is. So when you're in an acquisition, the time to find out that your insurance is going up 30% is when you're still in due diligence, not 2 weeks before closing or the week before closing, when that changes things for your loan. So we've done a great job on that as well. Like I said, the focus has been for commercial real estate and trying to match the deal flow of a real estate transaction. So to the extent we can help with any insurance quotes out there, happy to take a look at those as well.
Awesome. Yeah, I think that's enough of a sales pitch there. Just say we understand what a due diligence period is.
Right. I can't make your premiums any lower, but I can tell you during your due diligence period, not the week before close. Yeah.
Nice. Well, Scott, thanks so much for being on today. Always a pleasure to talk to you, and looking forward to the next time we get together.
You bet. Thanks, Taylor.